Hello, good morning. It is 5 minutes past 11, and we are going to start our. I hope that you'll have time to look at the readings because these lectures. Now, our lesson for today is accounting for royalties. Now, the objective of this lesson is to ensure that you as a student you are able to define what a royalty is. There are also some terms that you should be able to define. You be able to define a landlord, tenant, minimum rent, not workings, and you should also be in a position to prepare royalty. Now, I want us to move straight away to the definition of terms in accounting for royalties. Now, you find that royalty is payable by a user to the owner of the property or something on which the owner has special rights. We will look at the types of royalties after looking at the terms that we will be using. You also find that a royalty agreement is prepared between the owner and the user of such property or rights. Now, if the payment is made to purchase the right or property, then that will be treated as expenditure instead of a royalty. Now, when you buy a right or you buy a property, then that is not a royalty. So now our question is now, what is a royalty? Now to answer that question, I want us to look at the right. Now a royalty is a periodic payment which may be based on a sale or output. Periodic payment which may be based on a sale or output. So the sale is the payment is made periodically, maybe at the end of the month, can be at the end of the year, or maybe on a quarterly basis, or on a half yearly basis. Now, the other term is the landlord. Now, the landlords are the people who have the legal rights on mine, quarry, or patent right, or copy book rights. So we'll explain those terms when we are looking at the types of royalties. Now, our next term is tenant. Tenant, this is an author or a publisher who takes out rights. These rights may be commercial or it may be personal rights from the owner on the lease against the consignor. So that is the tenant. Then we have the minimum rent. Now, according to the lease agreement, now between landlord and the tenant, the landlord and the tenant, or the lessee and the lessor, the minimum rent, which is also referred to as fixed rent in some books or dead rent, it is a time of guarantee made by the lessee to the lessor in case of shortage of output or production or sale. Now it means that the lessor will receive a minimum fixed rent. Now the lessor is now the landlord. The lessee is the tenant, the person who is leasing that property or leasing the mine or the lessor will receive a minimum fixed rent irrespective of the reason or shortage of production. So it is the minimum amount that the tenant must pay the landlord, whether there is a production, whether there is a low production or not. That minimum amount should not, the amount paid should not go below the minimum. And our next term is short workings. Now, remember we have talked of the minimum rent. So the short workings is the difference between the minimum rent and the actual royalty. Difference between the minimum rent and the actual royalty. And it comes out when, for example, if we give an example of a minimum rent of 10,000 shillings, and then you find that at the end of the year, because the royalty amount is calculated based on output, maybe the total amount from the output is 8,000. So the output is 8,000, but the minimum rent is 10,000. So the difference between now the minimum rent and the output, that is what we call a short work. So if you have a minimum rent of 10,000 and the output of 8, so it means that the short working will be 10,000 minus 8,000, and that is 2,000 shillings. Our next term is the ground rent. Now, the ground rent is the rent that is paid to the landlord for the use of the land or surface on the yearly or half yearly basis. Yearly or half yearly. Number 7, we look at the right of recouping. Now, in the royalty agreement, remember that there may be a clause that the minimum rent that is paid over the actual royalty, which is the short workings, may be recoverable in the subsequent years. So when the royalty is in excess of the minimum rent, then we have a short working. So there may be an agreement that now for this short working that you are to collect it in the subsequent years. So that is what we call a right of recoupment. That is what we call a right of recoupment. Now, the right of recoupment will be decided for the fixed period or for the floating period. Now, when the right of recoupment is fixed for certain number of years from the date of royalty agreement, it is said to be fixed or restricted. Now, on the other hand, now when the lessee is eligible, when the lessee is eligible to recoup the short workings, maybe in the next 2 or 3 years from the years of its commencement, then it is said to be floating. Said to be floating. Our next item is the lease premium. So this is simply an extra payment in addition to royalty. This is paid by the lessee to the lessor, and it will be treated as a capital expenditure. So it will be written off on yearly basis through the profit and loss account. The other one item is the TDS, or tax deducted at source. Now, if there is an applicability of tax deducted at source as per the income tax, then the lessee will make the payment to the lessor after lessee will make the payment to the lessor after deducting the tax deducted at source. Then he will be liable to deposit it to the credit of the central government. Now, the amount of the royalty will be the gross amount of royalty that is inclusive of tax deducted at source, and will be charged to profit and loss. Next, we look at the types of royalties. Now we have 3 types of royalties. The first type is the copyright. Now the copyright simply provides a legal right to the author, that may be of his book or books, maybe to the photographer, or any kind of intellectual work. Now, the copyright royalty is payable to the publisher, who is the lessee of a book, to the author. Now, the author now is the landlord or the lessee of that book, or to the photographer. It is always based on the sales that are made by the publisher. The other royalty is the mining royalty, and this is common in most cases. Now, for the mining royalty, the lessee of a mine pays a royalty to the lessor, the mine, or the landlord, and it is always based on the output, maybe on the number of tons that are mined, the number of lorries, and so on. It will be based on the agreement. Then lastly, we have patent royalty. Now, for the patent royalty, that is always paid by the lessee to the lessor on the basis of output or production of the respective goods. Production of the respective goods. Now, we may have an illustration. So, for example, if we have MS Hyderabad publication printed a book on Java on the minimum rent of 1 million shillings. So the minimum rent in such a case is 1 million. It is payable per month, per annum, sorry. Now, the royalty being payable is at 20 shillings per book sold. So for every book that is sold, then they are supposed to pay a royalty of 20 shillings. Now, in the first year of publication, Hyderabad publication sold 75,000 copies of the books. In the second year, the number of sold books fell to 5,000. Now calculate the amount of royalties paid. Now to solve this, first of all, we have to work out the amount that is due based on the output. Like now in year one, the publisher now, the publisher sold 75,000 books. Now for the 75,000 books, now the output, we will take the 75,000 books that sold times now the 20 shillings per book. And if you multiply 20 by 75,000, that will give us 1,500,000 shillings. Now that is the output. So when you are looking at the royalty that is payable, now you will compare the royalty that is due with the minimum rent. Now in our case, the royalty that is due is 75,000 times 20, which is 1,500,000. But now the minimum rent is 1,000,000 shillings. So in this case now, you find the royalty amount that is due exceeds the minimum rent. And therefore what will be paid is the royalty that is due, which is 1,500,000. I hope I'm clear there. Now, in year two, we are told that now the number of books that are sold fell to 45,000 shillings. Now, to now calculate the amount of royalty that is payable, we'll now take the 45,000 copies that are sold multiplied by the royalty amount per book, which is 20. So we'll multiply 20 by 45,000. And if you multiply that, you will get that the royalty amount that is due will be 900,000 shillings. Now, in this case now, to determine the royalty that is payable, now we will compare the royalty that is due, which is 900,000, and the minimum rent, which is 1 million. And for that case, because the royalty due is less than the minimum rent, so you will find that now what will be paid is the minimum rent, which is 1 million, as opposed to 900,000. Now in this, our case here, you will find that now there is a short working of 1 million minus 900,000, which is 100,000. That is illustrated in the solution that we have here. So we have in the first year, we multiply 75,000 times the 20 shillings per book. That gives us 1,500,000. Remember, the minimum rent is 1 million. So the rent royalty payable will be 1,500,000. In our second case, because the royalty due is 900,000, so we find that what we will pay is just the minimum rent, which is 1 million. So that is how we go about it. Now we want now to move to now the books of the tenant. Remember, the tenant is now the leasee, the person who has now leased maybe a mine, or if it is a patent and so, or a copyright. So for the books of the tenant, now when the amount becomes payable to the landlord. For example, the 1.5 million that we have looked at. Now, if the amount becomes due to the landlord, one, the entries to be made is to debit the royalties account, debit the royalties account, that is the first one. Two, you are supposed now to credit the landlord's account. Debit the royalties account with the amount that is due, that becomes payable. Then you credit the account. When the amount is actually paid to the landlord, now when the tenant pays the amount to the landlord, then you debit the landlord's account, you debit the landlord's account, but credit the cash book, credit the cash book. Debit the royalties account with at the end. Now, when now we move to the accounting entries in the books of the lessee, when now we have a short working. Now there is a short working, then one, when royalties based on output fall below the minimum rent, like a case which we have looked at where we had but the royalty due being 900,000. So in such a case, one, we are supposed to debit with amounts based on output. So like for the 900,000, we debit the royalties account with the 900,000. Then we also debit the short workings before below the minimum rent. So if we look at our case now, we will debit the short workings account with 1 million minus 900,000, and that is 100. Then at the same time, we credit the landlord's account with the minimum rent. Remember, what we will pay to the landlord is the minimum rent, which for our case was 1 million. Now, when the amounts due are paid to the landlord, then we debit landlord's account again with the minimum rent and credit the cash book again with the minimum. At the end of the financial year, we debit the manufacturing account or the trading account, and then we credit the royalties. Credit the royalties. Remember to carry the balances in the short workings account as an asset. The balance in the short workings account, we will carry it as an asset. Now, in the future year, when the royalties based on the output exceed the minimum rent, the royalties based on output will exceed the minimum rent, one, we debit the royalties accounts with the amounts based on output, and we credit the landlord's account with the same amount. That is when they fall due. Now, when the amounts are paid to the landlord, now we debit, we credit the short workings account with the amounts saved, any amount that you have saved. Now, at the end of the financial year, we are supposed to debit the manufacturing or the trading account, and then we credit the royalties account. And at the same time, we'll debit the profit and loss account and credit short workings account with short workings written off as irrecoverable. Remember, we have said that for a short workings, we can have fixed or a floating. So if you are given maybe 2 years to recover the short working, and then you are not able to recover such an amount in the third year, so that is the amount that we refer to as short workings irrecoverable. Short workings irrecoverable. Then you are supposed to carry down the balance in the short workings accounts for amounts still recoupable in future years. So any amount that you can recover in future years, then we should recover it in those future years. So that is what we wanted to highlight today. Then we were supposed to go to our discussion forum and look at the practicability of administration. Now, I would advise you that once you get to watch this, after watching the presentation, you are supposed to move to the discussion forum, and there is an example there. So I will activate the discussion forum and also the notes which I have already posted. It's also a video that can also activate, so that anytime you get to online in lesson 1, you should be able to do the exercise that is in our forum. I'm also willing and very much ready to assist you in this unit. But remember, before you start preparing the account, one, you must prepare the analytical must prepare the so for the analytical table, what we mean by an analytical table is that you must know now for different years what is the minimum rent that is due. You must also know the amount of royalty due, and also if there is any short working. So first of all, that table, the analytical table contains one, the year in the first column. Then we also have the output. So for example, like in our case, the case that we have given, the output was based on the number of books that are sold. So for example, if you have 20 and you have sold 50 books, the royalty amount is 20 shillings. That will be 50 times 20. Then the next table will be the short workings. Before short working, so we have the year, we have the output, and then we should have column 3 for the minimum rent. Then our column 4 should be the short workings, and we have said short workings comes if the output is less than the minimum rent. So the difference between the minimum rent and the output, that is what we have as short workings. Then the other column will be short workings recoupable or recoverable. Then the other column will be short workings irrecoverable, if there is any. And then lastly, the royalty payable to the landlord. So that is what you prepare first, the analytics. So there is an example that I've also given in the video which you should be able to watch of how to prepare the analytical table. So you watch that, and once you have done that, you should be able to go to our discussion forum and be able to solve the problem that I have. So I welcome you in this unit, and I believe that now we should be able to go through the exercise that I'm doing. Please feel free to contact me. You can contact me through my WhatsApp number, 07804324. Any challenge. I'll also be online until the end of the class. For every day, just send a message.